claims that physically happened this year. One gives you this very long, uncertain tale of risk, and the other is much shorter and more defined. It's a huge choice about how you manage uncertainty over time. But here's the brutal reality of the market. What happens when the pressure to win business gets so intense that you start charging premiums that you know aren't enough to cover the likely claims and costs? It's a really tough spot because you're basically deciding to lose money just to keep your market share.
Well, you know the regulators have an answer for that. It's called the Premium Deficiency Reserve, or PDR. If the money an insurer has collected for coverage they still have to provide isn't enough to cover the expected future losses, they get forced to set aside extra cash right now to fill that hole. It's basically a penalty for underpricing a product.
And just look at this example. The fire division, profitable. Their combined ratio is 94%, meaning for every dollar they bring in, they spend 94 cents. Great. But health is losing a bit of money. And motor? Oh boy. Motor is a complete disaster, with a combined ratio of 127%. They're losing 27 cents on every dollar. And because of that, they're forced to set aside an extra 94.5 crore for their PDR. That is capital they can't use for anything else, all because of that commercial pressure to keep motor insurance prices low.
Okay, so we've got regulatory shocks, we've got commercial pressures, and now we have to layer on the biggest, most unpredictable pressure of all, a changing climate. Climate change isn't just a few more storms. insurance, it's an attack on the business model from every possible angle. Yeah, more frequent and severe weather is the obvious one. But it also means insurance might just become unaffordable in some places, which creates huge social issues. You could see brand new kinds of lawsuits. And here's the really critical part. The reinsurance that insurers depend on gets more expensive and harder to find. That forces them to hold much more capital just in case.
And this quote right here, it just nails the heart of the problem. For centuries, the entire business of insurance was built on one simple idea: using the past to predict the future. But with climate change, the past is becoming an increasingly unreliable guide. All that historical data is losing its predictive power.
So the direct result of all this growing uncertainty is that insurers have to be more conservative. They're forced to hold more and more capital as a buffer. And remember, that's capital that isn't being invested for growth or being paid out to shareholders. It's just locked away, sitting on the balance sheet for one reason: protection against a future that's getting harder and harder to predict. So, let's say you're an insurer. You're facing this perfect storm of regulatory chaos, brutal competition, and unprecedented climate risk. It sounds pretty hopeless, but companies aren't powerless. They have strategic levers they can pull to try and manage their financial health.
The first, and honestly the most powerful lever, is sheet solve.
At the end of the year, when all the claims are paid, the board has this huge decision to make. What do that money inside the company to make our capital buffer even stronger, or do we pay it out to our shareholders as a dividend?
And this brings us right to the central dilemma, that final trade-off that every single insurance executive has to wrestle with. Is all that capital a protective buffer, or is it a heavy burden that drags down financial performance?
This table just lays it out so perfectly. Look at scenario 1. The insurer pays no dividend. Its capital position is rock solid. I mean, a solvency ratio of 224%. But in scenario 2, they decide to pay out $50 million to shareholders, the solvency ratio drops, and now there's a real significant risk, more than a 5% chance that one bad year could push them below that minimum requirement. You make the shareholders happy, but you take on a whole lot more risk. It's a direct one-for-one trade-off.
But here is the tension. From a safety-first perspective, holding all that capital is fantastic. But from an investor's point of view, like this quote from the source material points out, the company can look excessively capitalized. That capital is just sitting there, not being put to work, which can really depress the return on equity. Investors want their money to be efficient.
And this isn't just some simple business choice. It's the core strategic challenge of the entire industry. On one side, you have resilience, holding enough capital to survive anything the world can throw at you. And on the other, you have efficiency, using that capital to generate strong returns for the shareholders who own the company. It is the ultimate balancing act.
Which leaves us with one final critical question to think about. In a world that is just getting more and more uncertain, is holding what some people call excess capital an inefficient way to run a business? Or, in this new reality, is it the only thing that guarantees you'll actually
Financial planning. And we're not just talking about balancing the books here. This is about making promises and actually being able to keep them, even when disaster strikes. So what we're going to do is peel back the layers of this whole complex process. We'll start with this one single decision that every insurance board has to make. From there, we'll look at the long-term game plans that, frankly, separate the companies that make it from the ones that don't.
Okay, so right at the heart of any insurance company, there's this constant push and pull, this battle. On one hand, you've got to reward your investors, right? The people who put their money in. But on the other, you have to guarantee, absolutely guarantee, that you have the cash on hand to pay out every single policyholder you've promised to protect. It's a real balancing act.
All right, imagine this. You're in the boardroom. There's 50 million rupees of extra capital sitting on the table. What do? Do you give it back to your investors as a nice juicy dividend? Or do you lock it away, keep it safe, just in case a rainy day comes? And that one choice, it has a huge impact on the company's financial health. We measure this with a number called the minimum capital requirement ratio, or MCR for short. Now look at this. If they keep money, that MCR is a super solid 224%. Awesome. But if they pay out that dividend, it absolutely plummets, all the way down to 99%. And falling just 1% below that 100% mark, well, that's a massive red line. That's one of the regulator companies' higher license to operate something online. They basically break fundamental promise made every single person who bought a policy. So you might be asking, how insurance is getting that control? Well, it's definitely not life. It all comes down to really carefully constructed financial blueprints. Think of it like a
in an extra safety buffer. It's a cushion of cash specifically set aside to handle the stuff you just can't predict. It's the price of buying a little certainty in a very uncertain world.
But what happens when the unexpected isn't just a small surprise, but a massive catastrophe, a giant hurricane, a huge earthquake? That's where reinsurance comes into play, and it's exactly what it sounds like. It's a financial match with a friend on everything. You each pay a set percentage of high deductible. This is where something called asset liability management, or ALM, is key. It's a fancy term for a simple idea, making sure the money they earn from investments is ready as cash at the exact moment they need it to pay claims. It's all about perfect timing.
Okay, but even the most perfect plan can fall apart when something totally unexpected happens. A sudden shock can shatter everything. That's why a huge part of this process is stress testing. They literally throw the worst possible scenarios at their financial models to see if and where they break.
And you know what one of the biggest stressors is right now? Climate change. And this isn't some future problem we're talking about. It's happening as we speak. We're seeing more frequent and more severe floods, storms, wildfires, you name it. And all of this is forcing insurers to go back to the drawing board on everything, from how much they charge for a policy to just how much cash they need to keep on hand to survive.
And here's the real kicker. To get ready for these huge events, they're leaning on these incredibly complex computer models, but as this quote points out so well, a model is only as good as the data you put into it. The problem is, when you're trying to model a once-in-a-century storm, well, the data is, by definition, pretty sparse. It's a highly educated guess, but it's still a guess. And hey, it's not just natural disasters they have to prep for. Sometimes, the shock comes from the regulators themselves. A single major change in accounting rules, like the big shift to IFRS 17, massive shockwaves through the whole industry. It can force every company to completely rethink how they value their business and report on their financial health. So, let's bring it all together. After all of this intense planning, all the modeling, all the stress testing, how do you actually know if you've done a good job? What's the bottom line? How do we measure success?
Well, it all comes back to that one number we talked about right at the beginning, the minimum capital requirement ratio. And the magic number, the pass-fail line, is 100%. Fall below that, and as far as the regulator is concerned, you failed.
So really, the whole point of this entire financial planning function is to make sure the company stays comfortably above that 100% line. That extra capital, that's the buffer, that's the shield. It's what allows them to get through any storm and, most importantly, keep that fundamental promise to their policyholders, to be there when things go wrong.
And that really leaves us with a million-dollar question, the one that probably keeps insurance executives up at night. In a world that just seems to get more and more unpredictable every year, how much of a buffer is actually enough? Just how big of a
Just about selling policies. It's a high stakes. For a general insurer, it's not just about selling policies. It's a high stakes financial game. It's about trying to predict the future, manage unbelievable amounts of risk, and most importantly, making sure they can always pay their claims. So let's take a look inside their strategic playbook at the complex models they built for a world that's getting more uncertain by the day. Okay, this slide gets right to the heart of the matter. On the left, in a totally normal year, this company is sitting pretty. Their capital is more than double the minimum they need. But look to the right, after just one major catastrophe, something they planned for, by the way, that massive gets squeezed and fast. And we're still solvent, but wow, it shows you just how quickly things change. This is a financial calculator every single day. And that line here, that's what you're trying to stay above. That's the MCR, the minimum capital requirement. You can get it as the ultimate safety net. And this isn't just something goal. Regular line stamp. They want insurance insurer has enough cash on hand to keep it promises to you, the policyholder, even after you lose this. And so it all boils down to this. Insurers' entire corporate strategy and everything they do revolves around one single objective. Human capital way above the minimum line. Every single decision applies to sell to invest in is all about building a protecting buffer to handle shocks around the town. But how do we actually build that all capital in the first place? Well, it all starts with product quality. It's an incredibly tricky process, figuring out how to price and insurance product, figuring out new complex risks, something we've never insured before. Yeah, creating an insurance product isn't as simple as just doing that. It's really deliberate strategic. He's ever really insured before. Yeah, creating a new insurance product isn't as simple as just dreaming it up. It's a really deliberate strategic process. First,
big picture goals. Then, do we actually have the skills to underwrite this thing properly? If the answer is yes, then they build these super detailed business projections, modeling out how it's all going to look for years to come. And only then do they make absolutely certain it follows every single rule in the book. It's a whole financial model before it's even a policy you can buy. And here's where it gets really interesting. For a lot of these complex commercial risks, there just isn't a giant database of historical claims you can plug into a formula. And that's where the human element is absolutely critical. It stops being a pure numbers game and becomes, well, part science, part art. It really comes down to the seasoned judgment of a skilled underwriter. But that judgment isn't just a gut feeling. Not at all. This is a perfect example of how they ground that subjectivity in cold, hard facts. To price something as complex as workman's comp, they're looking at everything. What industry are we talking about? What are their safety measures like? Have they had a lot of claims in the past? This is how they turn what seems subjective into a decision based on real, objective data. All right, so they've priced the products, the premiums are rolling in. What happens to all that cash? Well, it definitely doesn't just sit in a vault. They have to manage it, sometimes for decades. And that brings us to this huge financial balancing act, juggling their assets against their long-term promises, their liabilities. The investment strategy is completely For what they call short-tailed business, think car damage claims that get paid out fast, the money has to be liquid, easily accessible. But for long-tailed business, like a liability claim that might not be settled for 20 or 30 years, those assets have to be invested for long-term growth just to keep up with inflation. The model has to match the timeline of the promise. And this right here, this is the constant tug of war at the heart of their investment strategy. On one hand, the goal is to get the best possible returns on that giant pool of capital. But on the other hand, that goal is always limited by their appetite for risk.
Let's jump right into it. The choice of risk management
fundamental
and frankly, pretty dangerous
balance between growing their assets and ensuring rock solid stability. Okay, but what about the stuff you just can't predict? The big one, the kind of event that can shake the whole system to its core. The things that are, by their very nature, completely unpredictable. This is where financial modeling faces its biggest test, trying to put a number on the unthinkable. So insurers use these really sophisticated models, like the cost of capital formula you're looking at, to get ready for those unthinkable events. Now, don't worry about the math here. The core idea is actually pretty straightforward. This formula helps them figure out how much extra money they need to charge today to cover the cost of keeping a huge pile of cash locked away for decades, just in case some massive, once-in-a-generation disaster strikes. It's basically how they put a price tag on a radical uncertainty itself. But here's the catch. Even the absolute best models have blind spots. They might not cover every single part of the world or every single type of danger. They really struggle to predict the knock-on effects, like the massive business interruptions that happen after a major flood. And here's the big one. They are all built on assumptions about the past, assumptions that might not hold true anymore in our rapidly changing world. And those blind spots, they're a huge risk. So where does that leave us? Well, it brings us to maybe the most important point of all. Given all these challenges, financial planning for an insurer can't be a set it and forget it kind of deal. It has to be a living, breathing process. A constant feedback loop of building a model, watching the results, and then adapting the whole strategy to a new reality. And this right here is the elephant in the room for very bedrock of insurance modeling, all that historical data is becoming a less and less reliable guide for what's coming next. With massive shifts like climate change altering everything we thought we knew about weather, the past just isn't a perfect map of the future anymore. And that injects a huge amount of uncertainty into the very projections these models are built on. Which really just leaves us with this one massive question. And it's not just for insurers, it's for all of us. As the pace of change just keeps getting faster, the strategic playbook we've just walked through is being put to the ultimate test. The financial models that have kept this industry stable for decades now have to evolve, and they have to do it fast to navigate a future that looks less and less like the world we used to know. You know,
Right, let's jump straight in. There's a fundamental and, frankly, pretty dangerous assumption we need to tackle head on when it comes to climate risk. So many people think that annually renewable contracts are this magic bullet for climate change. You know, the idea that we can just tweak the rate every year and we're good. But this totally ignores the massive difference between a long-term, systemic trend and a short-term contract. It's a huge blind spot. And this quote just nails the central paradox, doesn't it? We operate under this assumption of a nice linear, predictable adjustment. But that's not how climate change works in the real world. It doesn't show up as a gentle slope. It shows up as wild volatility, as sudden step changes in how often and how badly catastrophes hit. So you're not looking at a small tweak in premium. You're looking at severe, unpredictable shocks to your portfolio that an annual repricing strategy has absolutely no chance of keeping up with. Which leads us straight into the first major issue. Just how fragile our foundational models are when they come up against risks that don't play by the rules.
And this is a perfect illustration of that conflict. On one side, you have the clean,
strict assumptions of the basic chain ladder method. Stable development, independent claims. And on the other side, you've got the complete mess that is crop and weather insurance, where literally none of that holds true. It's a textbook case of model failure.
Okay, so the really critical question is, why does it fail so spectacularly?